Good day, everyone. Chris Heerlein here of REAP Financial. Thanks for making me part of your day here. I want to talk to you about 4 retirement tax ambushes and how they can derail your retirement, but most importantly, how you can avoid these type of pitfalls. So when we look at a retirement plan, a lot of times we focus on income planning, portfolio going to grow enough to maintain our standard of living and really outlast us. That's the hope, right? Well, the things that can be often overlooked really can make a drastic impact on your spending and the longevity of that portfolio. So the first one we're going to talk about today is really the net investment income tax. When you are a high earner in your working career and even in your retirement career, if you're a married couple making over $250,000, you're getting hit with net investment income tax. It's NIIT. And this can stack up. And the reason it's important to know this for retirees is that additional 3.8% doesn't sound like a lot, but it can add up over many years. And you're going, well, Chris, how am I going to be in a $250,000 income range in retirement? Well, let me tell you something. Those of you that did a great job of saving in your retirement IRAs and 401ks are facing potentially huge required minimum distributions down the road. And it's not uncommon for families to have $150,000 required minimum distributions, maybe more. You couple that with Social Security income, pension income, those type of things, and guess what? You can find yourself over those limits. So not only are you in higher tax brackets in retirement, you're paying net investment income tax. So be mindful of that right there. Now, another thing, most Americans don't think they pay tax on Social Security. It's crazy, but over 80% of Americans pay tax on Social Security. You have to be at poverty levels to not be paying tax on Social Security. If you're married, you'd have to have under $32,000 of adjusted gross income to pay 0% tax on your Social Security, okay? If you have $44,000 or less, only 50% of your Social Security is taxable. Now get this, anything over $44,000 as a married couple, 85% of your Social Security is going to be taxed. I didn't say an 85% tax, I said 85% of your benefit will be taxed at your marginal bracket. So as you're planning for your retirement, when you see that little number on the corner of your Social Security statement, the benefit amount that you've been paying into for years, that's likely not the number you're going to net after tax. It's likely to be much smaller than that. And by the way, your Medicare premiums will come out of that as well. So as you're planning for your retirement, you can't just take that statement as face value. You need to be looking at how much of that money you're going to keep and coordinate that with your overall income plan. Now, understand this. Married couples, if you make over $206,000, your Medicare premium will start increasing. There's 5 different tiers, and it starts small, medium, large, extra large, and beyond. Okay, so for the average recipient out there, you're going to probably spend on Medicare A, B, D, and a supplemental somewhere in the range of $350, $375 per month per person. But would it shock you to know that we have families that are paying well over $600 per person for the same Medicare coverage that their neighbor's getting? That's true. It's because the Medicare premiums are dictated by your income. So what do we talk about? Tax on your Social Security so far. We've talked about tax on your net investment income tax for those of you high earners or those of you with nice lifestyles in retirement. We've talked about increase in Medicare premiums, but there's one more I want to talk about. It's what passed in recent years called the Secure Act 2.0. The Secure Act 2.0 changed the game in a lot of positive ways for retirees, but it also changed the game in some not so positive ways for your beneficiaries. Your kids, the people, the families that are going to inherit your wealth. Under today's law, they now require an inheritor of an IRA or a 401k to take that money out of the account within 10 years. Now, why is that a problem? Chris, if I'm inheriting wealth, isn't that a good problem? Yes. These are good problems we're talking about. But again, we want to make sure you don't grossly overpay in taxes. So before the Secure Act 2.0 passed, when you inherited an IRA, you could stretch that puppy out. They call it a stretch IRA, and you just had to take a little bit amount out every year, forced. It was called a required distribution. And you could just take a little bit out, let the money continue to stay in there and grow, and it really didn't make an impact. But if you inherited a IRA worth $1 million today, and you are forced to take that money out over 10 years, 100% of that money in a traditional IRA, traditional 401k is 100% taxable. So if you're thinking right now, well, I'm probably going to leave wealth to my kids some days. Well, when you pass away in your 80s, 90s, they're likely going to be in their 50s, 60s, 70s, in their highest earning years, where they're going to now inherit your pre-tax IRAs and have to pull significant amounts of money out, potentially, at very high tax rates. Because if they're already in their highest earning years and then they're having to pull an extra $100,000 a year out, all taxable, by the way, put on top of their income, the people up in DC, they deserve a little bit more credit than we give them. They got some of this stuff figured out. But here's the thing. There's potential ways to keep more of your wealth and beyond. I want you to get your hands on our updated Secure Act 2.0 report and know the pros and the cons that have come with this legislation. We'll send it to you at no cost. Email me right now, retire@reapfinancial.com. Retire@reapfinancial.com. My team will have it on its way to your inbox. Until then, all the best.